All right, so Tyrone asks how negative interest rates will affect his portfolio, his 401k and whatnot. It's a very good question. Very good question. It's interesting because we've literally never been through this for an extended period of time in the U.S. Even back in the Great Depression during that deflationary time, at least the 10-year bond never traded at negative rates. That's for sure. And when they're talking negative interest rates, they're just talking. About 2 months ago, I posted something about the 13-week, 90-day. Is that 13-week, 90 days? Yeah, 90-day. The 13-week T-bill was at negative rates back in March, right around the middle of March, and we hadn't seen that. We've probably seen it on occasion, but not very often, and certainly not for an extended period of time. And even right now, the 13-week is back above zero. I think what those guys, Graham and Meet Kevin are talking about, and any other people, they're talking about the 1 year T-bill being negative. It's not right now. It might have gone below zero for a few minutes, but will it go back to being negative? I suspect not, frankly. But let's just say it did. I mean. Again, it didn't. The 10-year, and I think everything you should look at the proxies of 10-year. Looking at the 90-day or looking at the 1 year T-bill, that's just. I mean, the Fed has so much control over that. I don't think that's a good proxy for the interest rates at all. I think the 10-year is the best proxy there is. Some people say 30-year. I don't think so. I think a 30-year is just too focused on long-term mortgages. Long-term debt. That's not most people. When it comes to debt, are looking at 5, 10, 15 years in terms of car loans, student loans, home equity loans, and stuff like that. So I think the 10 year is the best proxy you have. Intermediate government-backed security or government-guaranteed security because it's literally issued by the federal government. So until I see a 10-year even getting down to negative. I'm not worried. Now, the 10-year right now is, at least the last I checked, was like 0.69. So that means if you locked in your money with the federal government, you're getting 69 basis points or 0.69%, not even a full percent on your income as an interest payment. You're not even getting. I mean, that's nuts. During the Great Depression, it never came close to that. So you can see how drastic the interest rates are relative to historical times. So even though it's not negative territory, it's pretty doggone close. I think the lowest it got, the 10-year, I think it was like March 20th, it got down to, I believe, 0.27, I think, for a few minutes, but it never got negative. So if we really want to talk negative interest rates, until the 10-year gets negative, I'm just not all that concerned with it. When I say I'm not that concerned with it, it's kind of like we've been dealing with low interest rates now for a long time. So the 10-year being below 1% is a big deal, don't get me wrong. But I think we've actually been somewhat accustomed to that low interest rates. Really, since going back to 2008. So no one's jumping off a bridge. Oh my goodness, the 10 years at less than 1. And we've been there. Ironically enough, in May of 2018, I posted a video that said the 10-year just broke 3%. Say goodbye to low interest rates. And that's when I just started my channel. I started my channel in March of 2018, and I was wrong. Look at that. I mean, May of 2018, we had the 10-year breached the 3% mark. And again, the 10-year historically has been around 5. So for it to be at 3 and even breaching that, it was pretty extraordinary, but that was still extraordinary low, if that makes sense. I'm like, man, ay. And here we are at 0.69 or whatever it is, 0.65, 0.71. Either way, it's less than 1% right now. All right, so what does that have to do, negative interest rates or even low interest rates for your portfolio? Well, here's what happens. A couple things going on there. The lower the interest rate on your safe money, the more inclined you are to do one of two things. Invest it in appreciating assets like stocks and real estate. And more people invest, they get out of safe assets, the more the prices of these assets go up, they're inflated. The more that happens, there's something called the wealth effect, which people say, hey, My portfolio is up. That makes me feel richer. I'm going to start spending money. That's one thing that that we would like to see in terms of economists, in terms of a stimulus, the wealth effect. And the idea would be the way you do that is you make it painful to hoard cash because they're not going to get any interest. If they don't get any interest, they're not going to hoard cash in bonds or never mind just good old-fashioned savings accounts. So they have to do something with it. And so what they're going to do with it is like I said, they're going to consume it, i.e. spend it, or they're going to invest it and grow real assets, or I should say real assets, potentially appreciating assets. But Josh, bonds are appreciating assets. No, they're not. They're not appreciating assets. Bonds are a fixed asset. Fixed asset is inherently a non-appreciating asset. You literally know what you're going to get. That is not debatable, man. That's not. Some people say, well, my bonds were up 19% last year. It doesn't matter. I'm telling you right now, if you're getting a 4% coupon on a bond and it's up 19% in year one, inherently it'll have to be down at some point. What's that? 19 minus 4, 15%. In just basic simple math here, it cannot not do that. It has to go down. If you got 19% as a temporary gain on a bond that's paying you a 4% coupon, you will relinquish 15% of that at some point. Now you might relinquish 15% of that 1% a year over 15 years. You might relinquish it. But I guarantee you're going to relinquish that gain. I guarantee it. Because a bond is a fixed asset. It has no appreciating value at all. None. I'm just telling you. Nothing could be simpler in investments than a bond. A bond's no different than a certificate of deposit, to be perfectly honest with you. People understand CDs. They take $100,000 to the bank. They get 5% interest. 5 years they come back and collect $100,000 with interest. Bonds are actually even simpler than that, frankly, because a bond doesn't reinvest. It can't. The bond's issued. It doesn't reinvest. It just gives you a coupon. So you got your $100,000, you buy a 10-year treasury bond at 5% interest. Every year you're getting $5,000 a year. It doesn't reinvest in the bond. You put it in your bank account, you put it in your stocks, you spend it, whatever you want to do. But you know for a fact, you put $100,000 in a 10-year treasury bond, you were in 10 years are getting $100,000 back. No more, no less. That's literally how it works. A CD, you put $100,000 in a CD, if you reinvest interest, it does compound. It doesn't work like that with bonds. I just wish people understood the bonds, how they work. Because once you kind of grasp that and you see the low interest rates that we're in, you're like, yeah, is it really worth it for me to take the risk on these bonds given the low interest rates? And I don't think it is. Not in corporate bonds, no way. All right. So the wealth effect would, in theory, provide that your stocks would actually do better and your real estate would do better simply because you're sacrificing low interest for more risky, that's probably a better word, riskier assets. That's probably a better word than appreciating assets. You're saying, look, I know I'm not going to get much money, if any money, on my bonds and my cash, so I'm going to invest in a little bit more riskier asset in which to earn more income or more growth. And that's that. And so the more people do that and they get out of safe fixed assets and go into riskier assets, the idea would be the more the markets increase, the more the markets increase, the more the wealth effect takes place. The more the wealth effect takes place, the more people consume and spend money because they have this feeling of wealth. So that's one aspect, Tyrone. Part two would be it makes you consume anyway. So it increases the GDP right out of the gate because you're saying, well, whoa, I got $10,000 in savings. I'm getting 2% right now. I have been, so that's not much, but at least I have some guarantee, and I'm also getting a little bit of interest. Well, now I'm actually not getting any interest. So this isn't good. So what am I going to do? Well, in that case, you'll consume it. You'll say, I've always wanted that, that new guitar. So I'm going to go buy that new guitar, if that makes sense. I've always wanted a greenhouse to grow strawberries. I'm going to go ahead and buy that greenhouse. And so that as a consumption, they don't really call it a consumption effect, but I guess I can term that the consumption effect, which says, hey, because you have no interest on your bank accounts and your savings accounts and your bonds, essentially, you're going to go ahead and spend that money, which will also add to increase in GDP, which would theoretically increase the riskier assets growth as well, because riskier assets are based, some of the growth is based on earnings. Earnings, of course, is based on consumers spending, and GDP certainly is based on consumer spending. So the idea would be your riskier assets would benefit from a consumption boost because of low yields. So both these are theoretical. Both of these are theoretical, and none of them have come to fruition in Japan. So it inherently makes sense from a chart perspective. Someone was telling me that guy at the Money GPS has all these charts. I like the guy who commented. He has all these charts and true facts to show that it's only a matter of time for America is no longer the currency of the world. Look, I mean, all countries come and go. I don't have any qualm with that. I guess Egypt's still around. But anyway, but the charts are very, let's just put it this way, the charts work until they don't, all right? And I always revert back to the Phillips curve and Paul Samuelson, the esteemed, I think he did win a Nobel Prize. I think he was the founder or the father of econometrics, which really took the economics profession with all their science envy into a whole new realm, which made it not be so philosophical. They actually kicked the philosophical out and make it more statistician. And of course that doomed the industry, or I don't want to say doomed it, but in my opinion, really hurt economics as a profession, because it's all based on models, and the models are crap. We know that. The Phillips curve, Paul Samuelson. So remember, Paul Samuelson, with all his models in 1989, predicted in his textbook, which is probably still being used to this day, that the Soviet Union would overtake the U.S. in economic output in 1989. I'll leave you guys to figure out what happened in those years and how insanely absurd that would turn out to be. But his models proved it until they didn't. So anyway, at the end of the day, the models and the theoretical make sense about the wealth effect, the consumption effect going hand in hand. But then we look at the real world, and which is Japan, and we're not seeing that. We're just not. So anytime somebody argues these things, I just ask them to say, well, how do you explain Japan? I did a video of that just a couple of days ago. Explain Japan. Haven't heard any good explanations. The only explanation I ever hear is Japan has, they loan themselves more, they basically, they owner of their own bonds. Okay, well, the United States is too, for the most part. I mean, Japan owns more as a percentage of the total GDP or debt, but it's not like the U.S. Doesn't own the majority of our own bonds. All right, so that's not a good explanation. Japan doesn't allow any immigration. That's okay. I mean, that's some of a explanation. I don't think that's enough to see that Japan has been in a basically deflationary environment almost, and certainly negative interest rate environment for 25 years. Demographics, the demographics are older for sure. Every country is getting older, man. That's a fact. So you just got to say, how do you explain Japan? And the answer is Japan should never exist. But you don't even have to go to Japan. You go in our own state, our own country. How do you explain low unemployment that we've had in the United States until the commie virus and the insane shutdowns? How do you explain low unemployment, low inflation, low interest rates? None of the charts, none of the theoretical observations would have shown that. None of them did. And yet it's not just Japan, it's here. Low unemployment, low inflation, low interest rates, low growth. These things should not happen. And yet here we are. How do you explain that? Well, you explain it because human natures are different than models. Models can't predict human beings. So, Tyrone, as we sit here today, saying this is what should happen, then it's anyone's guess. The should and will are completely opposite. And the will is what's happened in Japan, at least what we're seeing. Does that mean it'll happen here? Man, I got no clue. But should you change anything? I wouldn't. I mean, imagine you invested in a well-diversified portfolio based on your long-term investment needs. Well, I don't think that changed just because the interest rates go south or negative. So I'd keep doing what you're doing. Hope this helps.